Venu, are we ready? Okay, so good evening, everyone. I hope I'm audible to all of you. So welcome back to the second session on cost of capital. And I can see a lot of responses already on the panel, which is, okay, one query also is already there from Shreya. Shreya says, can you please explain the calculation of growth rate? Shreya, I'm not sure like if you attended the last lecture, we talked about the calculation of growth rate basis two aspects. One was the average method based on the past growths, and the other one, which is more prevalent, was based on the Gordon model. That is what we discussed in the last lecture. That was B into R. That is your retention multiplied by the return on the investment. So the idea about the growth was the amount of reinvestment that is done in the earnings or from the earnings rather, and we take that into account to calculate the cost of equity. So we had discussed this exactly on this particular slide, right? So Gordon's growth, where we're talking about calculation of the growth rate. Okay, so now just need to check one thing from everyone is, guys, have you all covered whatever we have done till now, the cost of debentures, preferred stock, equity? I hope you got a chance to look back of whatever we have covered, when to use current market price, when to use the net proceeds in terms of the adjustment of flotation cost. So I hope everyone is on the same page. Now, what we had to resume today was from cost of retained earnings. Now, this is where actually it's a good way to start when we were talking about the cost of growth rate. It was basically because of this aspect as well, wherein we talk about, we all understand that all the earnings of any organization are not distributed to the shareholders. Now, if not distributed, that's a management decisions. It's like more from a corporate governance that the investors trust the leaders, the management, that they know the board of directors know the best interest of the organization. They want to retain some part of the earnings for expansion. Now, think from an investor perspective. Organizations are earning, but they're not getting everything in return. Rather, they are getting some dividend only, right? That's what we talked about. Of course, in that regards, the amount which is retained by the organization is like kind of an opportunity cost. The amount of dividend that could have been given to the shareholders, but it actually was not, right? So we are talking about in terms of that cost of retained earnings is very similar to what is in the form of dividends, or what we calculate for cost of equity. So it's very important to understand that generally the cost of retained earnings is nothing but same as cost of equity. Why so? Because it is the earnings only. That is the difference only is that it is not distributed, right? Now, the only factor is when we say that, okay, cost of retained earnings and cost of equity are equal, we need to be very careful that if the company goes for issuance of new equity, new share capital, in that case, we will not hold by our treatment. We will not say that, okay, our statement holds true in that case. Now, the idea is that, as I said in the last class, that when we're talking about issuance of new capital, there will be transaction cost. That means the net proceeds would be lesser. And in that case, the cost of equity would be slightly higher for us. So we'll need to be very, very careful for that. That yes, because the denominator is what we are talking about is lesser because of the net proceeds, and hence the cost of equity would be higher than the cost of retained earnings in that regards. Otherwise, as a general rule, we will say that yes, cost of retained earnings is equal to cost of equity. So we talk about the same methods. Now, we will talk about certain practice questions. We will talk about coverage with respect to the same, how or where we can decide that, okay, should we take KR is equal to KE? Should we take KE as a different cost factor altogether? Now, There are a couple of things here. We are talking about there are no taxes and no flotation cost. This is something which I have already discussed that yes, this is except for the new equity, my KR is equal to KE. But if there are taxes, mind you, and flotation costs, then cost of retained earnings is cost of equity multiplied by 1 minus T and 1 minus F. Now, let me talk about this formula here. 1 minus F portion is more of with respect to the flotation cost, because at the end of the day, if we are talking about issuance of the new equity, we would have incurred some flotation cost, guys. Yes or no? Had we not got retained earnings, but we would have issued new capital, we would have incurred some flotation cost. So 1 minus F reflects that, okay, if there is 1% transaction cost, 0.05% transaction cost, so this will take care of that. But what about 1 minus T? Can anyone tell me the significance of 1 minus T? I can give you a hint. Think from an investor standpoint. You know, T is a tax rate, but we are specifically talking about personal tax on dividend in this case. We're talking about T is personal tax on dividend. Can anyone tell me why we are doing this personal tax on dividend? Why we are multiplying this by 1 minus T? Would anyone like to answer that? Smita says tax benefit. Okay. Smita, I think where you're coming from is what we discussed for debentures, right? Mind you, for dividends, they're not tax deductible, right? So I would not go look at that from a tax benefit perspective, but think closely from an investor standpoint. Khushi says TDS. Okay. Anyone else would like to answer that? Sarthak has a very interesting point. Taxes are levied on dividend as income from other sources. So that is included in cost of equity. Aditi says dividend is income and tax is deducted from it. So Aditi and Sarthak, I think I loved your responses. I think both of you indirectly are trying to say, which actually I wanted to hear, is if investor would have got these earnings as dividend, they would have paid the taxes on that. So probably net opportunity cost would have been net of tax, because we are looking at cost of retained earnings only as opportunity cost, right? It's like more of a dividend foregone by the shareholders. Had they received the amount as dividend, they would have paid taxes on that, right? So the net benefit from an investor perspective, expectation from investor perspective would be 1 minus T only. I hope everyone is okay now. Guys, does that make sense? And I think both Karthik and Aditi, that was good answer, I'm sure. And Hitesh, you were talking about tax evasion, but I'm sure Hitesh, you are also talking about that. And in fact, Ban Reddy also gave the same response. So good job, guys. I think good answer initially from Sarthak, Karthik, everyone. Absolutely, guys. Perfect. So that is good to understand that, yes. So broadly, how we look at it is from our examination purposes also, we have to be very careful. If nothing is given to us, we can say that, okay, cost of retained earnings is cost of equity. But when they're talking about raising of additional capital, then we will talk about cost of equity as different. That means, can we say that if I'm talking about raising of additional capital, that means in that case, cost of retained earnings would be cost of existing equity. And for cost of equity, we may have to calculate a separate cost factor. I will talk about that in some examples here. However, when they are talking about personal tax rate and flotation cost both, then you have to use the second formula. Now, let's look at this example or this illustration at the bottom. Face value of the equity shares of company is rupees 10. Current market price is 200. Now, company is going to start a new project, is planning to finance. Now, look at this, please. These are keywords. We are planning to finance it partially by new issue and partially by retained earnings. When we are required to compute the cost of equity of equity shares as well as cost of retained earnings, if the issue price is 190 and the flotation cost is 5 per share, and they're saying that, okay, dividend at the end of the year, first year is expected to be rupees 10 and growth rate is also given here. So what do you guys think, guys? How we should proceed in this case? We need to calculate cost of equity and cost of retained earnings. First question here is, can we say that cost of equity should be equal to cost of retained earnings in this example? Yes or no? Can we say that? cost of equity should be equal to cost of retained earnings? That is my first question to you, all of you. Let's see your responses. Okay, I'm getting mixed responses till now. Let's see what you guys have to say. Okay, mostly students are giving me answer as no. Couple of answers were yes also, but Sarthak and Siddharth, these guys are mentioning about the flotation cost element. Yes, but also, as I said, that don't you think they are anyways talking about starting the new project by two sources? One is with the retained earnings, one is with the new capital. For the new capital, there will be a flotation cost. So if I say that general rule is cost of equity is equal to cost of retained earnings, but we are not talking about the new equity in that case, right? But in this particular illustration, we are talking about the new equity. So can we say for cost of equity, I will have to calculate for the new capital considering the transaction cost? So for the cost of equity, we are talking about additional capital. Hence, we need to calculate the KE. But for KR, because it is already there, we can use the existing market price for net proceeds. So who will tell me what should be the cost of equity in this case? Who will tell me what should be the cost of equity in this case? What do you think, guys? Cost of equity, calculating the Gordon model. So we are talking about a dividend at the end of the first year is expected to be ₹10 and growth rate is given to us at 5%. What is my D1? What is my D1? That's a key part, right? We are given dividend at the end of the first year. So I probably feel we already have D1. We do not multiply this by 1 plus G. So we are talking about D1 upon P0 for KE that is given to us as 10. Net proceeds are 190 minus 5 plus growth rate 0.05. Can anyone tell me what is the cost here? Karthik says, what is the reason behind the underlying assumption we took the cost of equity is equal to cost of retained earnings? Karthik, because the cost of retained earnings. So what? How do we calculate cost of equity? Based on the dividend expectations, right? Retained earnings is something which is anyways would have distributed as a dividend had the same not been retained by the company. That's the logic. But when we are going for the new equity, then the cost of retained earnings will not be equal to cost of equity. Karthik, I hope that makes sense. In the meantime, a lot of students have given me an answer for this as 10.41%, which is looking good to me. So what we are looking at is D1 upon P0, where we're using the net proceeds. So we're looking at 10.41. But my point is, look at this. For cost of retained earnings, we are using the existing equity because in the question, if you see, we are talking about the 200 value that is current market price in the first line itself. So the KR is equal to 10%, but KE is the cost for the new equity, guys. I hope this makes sense. I think this is a good illustration to clarify the point which I was talking about, that my conclusion from this is that as far as the general rule is concerned, we can see that cost of retained earnings is equal to cost of equity, but except for new equity, you have to compute a different cost of equity altogether. This makes sense to everyone, guys? And based on the responses, I can see majority of you got it correct. So that's a good one. Everyone okay, guys? If you are fine with that illustration, can you try the next one, please? Now, in the next one, we are saying cost of equity of a company is 20%. Now, look at this, please. They're giving you a lot of information. Flotation cost is 5%. Now, they're giving you personal income tax of 30%. Now, for this, you have to use that formula where we're talking about netting of the income tax and the flotation costs. So we multiply the 20% into 1 minus 0.3 because you would have received 70%, 30% would have gone into taxes, and 0.05 would be the flotation cost. So the net answer would have been 13.3% here. In case they give you the flotation cost and the personal tax rate, only then use the formula, please. Only then use this formula. Okay, so couple of brain teasers in front of us. Calculate the cost of retained earnings for following scenarios. Option A, D0 is equal to 5, P0 is 50, G is 5%. Anyone would like to answer that for me? Okay, so you guys calculate the cost of retained earnings for both A and B and give me your answers, but mention A or B while you are answering this, please. While you are answering the question at the bottom, please answer whether you're giving me answer for A or B. If you have calculated both, you can give me both answers. Waiting for some responses here. Okay, Aditi, Sudhanshu, Madhushri, Sarthak, I received your answers till now. In fact, amazing, guys. So Karthik, Khushi, Smita. So I think all of you are correct, guys. For option number A, where we're talking about Gordon model, they've given you D0. The only catch was to calculate the D1 here, nothing else. So D1 upon P0 plus G, that is your 15.5%. That looks good to me. Okay, what about part B, guys? Part B. Remember the security market line, the CAPM model. Okay, Raghavan, I think, did you miss out to add G over there? I think you need to add G also, right? D1 upon P0 plus G. I think you got your answer, but I think G had to be added. Same with Akash Neel. Akash Neel, I think I could see that part missing in your answer as well. For part B, I think many of you are giving me answers 11.2. That's absolutely correct, guys. So those of you got answer of part A as 15.5, good round of applause. Same goes for your capital asset pricing model. Mind you, what I told you is you have to be very careful. What if the question gives you a market risk premium in the question? If they are giving you market risk premium, they are already giving you RM minus RF. So don't subtract RF again then. Make sure that you do not do that mistake. In this case, they were not giving that. It was a straightforward one. RF plus beta into RM minus RF. That's absolutely correct. And those of you got option number A as 10.5, I hope you got that. There was a G factor as well. Growth rate had to be added. Amazing, guys. So let's see how you guys do on this couple of MCQs. Question number 1 and question number 2. Again, the rule stands the same. While you are answering, please mention question number as well. So 1 minute for each question, guys. Not more than that. So I think I am getting some answers for question number 1, though there seems to be a uniform answer, but there are different answers for question number 2. Okay, so guys, question number 1 says they've given us cost of equity, but they're asking us beta. So cost of equity is 18% and RF is 6%, that is plus beta. And we're talking about 12% minus 6%. RA minus RF. So in that case, beta seems to be 12 upon 2, 12 upon 6 seems to be 2 here. So yes, option number D is it. Absolutely correct, guys. Now, looking at the responses, now for the last 7, 8 responses, all the students are giving me one uniform answer. Initially, there was confusion between B and C. But I believe that majority of you are going with option number B. See, the idea was, which of the following source of funds relate to reinvestment or implicit capital? See, both the terms reflect to retained earnings only, right? So what is the source of reinvestment? You don't earn, distribute the earnings, you reinvest in the business. It's kind of an implicit. So it's definitely a retained earnings, guys. Absolutely correct. Initially, some of you were answering me option number C, but that's not the correct one. It has to be retained earnings. Okay. What about these two guys? Question number 3 and 4. Give question number with your answers. This is interesting actually that for question number 3, I'm getting different responses. Up till now, I've got 3 answers, guys. For question number 3, students are answering A, C, and even D. Wow. It's nice. Okay, I think probably some of you are overwhelmed with the options here. I think some of you just taken away with only with the first option, like retained earnings do not involve any cost. Definitely, it's not correct. We studied today itself. Retained earnings also have a cost because cost of capital is with respect to the expectations of the investors, and that money is not given to them, rather reinvested. But there is something mentioned here: weighted average cost. Although we are yet to cover this, they're saying that it is sum total of cost of capital from various sources. We will see that today itself that it is not a sum total. When we use the word weighted average, guys, we all know that it's definitely different costs are multiplied by the weights, right? It cannot be just adding up the different costs and get a sum total. That's not the case, because the capital structure can comprise of different sources of capital: debentures, preference shares, equity, retained earnings. So you have to multiply the cost of capitals with different weights. We will see that today. So even this is not right. Look at the C. Tax shield on preference dividends reduces cost of capital. Is there a tax shield on preference dividend, guys? I seriously don't think so. Karthik, I hope now you're getting it what I mentioned in the option number B. So option C is also incorrect. So guys, correct answer is D, all of the above, because all the statements are false. The preference dividends do not have any tax shield. It was only debenture interest. So D is the correct answer. I hope everyone got it now. I think most of you had confusion with option number B only, right? I can give you benefit of the doubt that we are yet to cover weighted average cost, but I'm just telling you that just for the basic understanding of the concept of a weighted average, you do not just add the different totals, right? You just apply the weights and then calculate the weighted average. So D is the right answer. For question number 4, guys, interest on government bonds. I think, did we discuss something on the last slide in the last class? I showed you how the risk increases from government bonds to the corporate bonds and to the equity shares. So the interest on government bonds is definitely the risk-free rate of return. I think question number 4, most of you got it correct. There are only 1 or 2 students who mentioned D, but rest of you mentioned option number A. There are a couple of students I can see who mentioned D, guys. It is not market rate of return. Let me show you that slide. This one, guys. So we talk about government bonds, corporate bonds, then we talk about preference shares, and then equity. So government bonds, when we talk about government bonds, government debt securities, those are definitely the risk-free rate of return, guys. I hope this makes sense to everyone. So answer is A. Okay, so with that, we start the most important aspect which we need to talk about today, and then we'll proceed for a lot of practice. And as I said, I promised we will be doing some practical questions, and of course, a lot of the learning depends on the practice done by you guys at your home as well. Now, as the title suggests, weighted average cost of capital, as I was explaining in the last MCQ, that when we talk about weighted average, when we talk about the capital structure, we know that every organization might have capital from different sources. It could involve the debt in terms of debentures, preference shares, equity shares. So once we understand that how to calculate the cost of capital of each individual component, we also know that capital structure is combined of multiple components. Then we have to calculate the weights for each component and multiply that to that cost of capital. So basically, when we for example, we are looking at a simple example here. Let's say on the top, I'm writing here that you have a debentures of 1 lakhs. And you have equity shares for, let's say, 1,50,000. And the cost we have calculated for debentures, let's say, is 10%. And we have calculated this as a 15%. Now, if I have to calculate the weighted average cost for this scenario, I have to see what is the total capital here. Or I could have said that, okay, the ratio of debt or equity is 2:3. So probably how do we calculate this is multiply this by 2/5 and multiply this by 3/5. Guys, does it make sense to everyone? So my weighted average cost of capital is 13. That MCQ talked about, if I had just kind of simply added the cost of debt and cost of equity, I would have arrived at 25, which would never be incorrect. It's actually 13%. Madhushri has an interesting question. Please give us some tips on how to approach the exam that is within 2 months. Madhushri, only one way to approach the exams. Just study, practice, and practice, nothing else. Avoid all the distractions. I'm sure those of you have watched Chak De India, right? Just remember that speech of wo 70 minutes. For you guys, it is like wo 70 din. So those 60, 70 days are crucial for you from here on. I'm sure each one of you are sailing in the same boat. Remember one thing, guys, all of you have one thing in common, that's time. And I think equally apart from the time, equally the distractions. So you have to be just avoid the same. That's it. Okay. Akashni says, why did we use 2/5 for debentures? Akashni, because I just assume 1 lakh and 1,50,000, right? So if I see my total capital structure is like comprising of 2,50,000, so 1 lakh divided by 2,50,000, isn't it 2/5? Guys, can you just please check my calculation? 10/25 is 2/5, right? So what I'm trying to say, Akashni, is like 10/25, 15/25. Is everyone okay here? Weighted average cost of capital. So basically what I'm trying to say is for each component, we are just multiplying the weights for debentures, for preferred stock, for equity, for retained earnings. That's it. Now, at sometimes weight can be tricky. Like on what basis we need to be taking our weights? Should we take the weights on the book value, what is reflecting in the balance sheet, or probably we all know that the market value of those components can be different, right? We know that, let's say for equity, your equity comprises of your share capital, equity shares, retained earnings. Probably there could be a different market value than the book value. Now, generally, your question in the examination will guide you whether you are supposed to take the book values as a weight or market value, or probably they can have two sub questions. They can ask you to calculate using different weights. So the idea is that it's very important that we need to be very careful at what weights to be used, whether we are talking about the book value here or we are talking about the market value. Now, one important point is when they give you the market value of the equity, please mind this fact, very important. When they're giving you market value of the equity, the market, so retained earnings is included therein. So market value of the equity, it doesn't mean that it's only for equity share capital. It includes equity share capital and retained earnings, guys. In that case, market value of the equity can be proportioned based on the book values of equity and retained earnings. I will share the example for this though. Now, this is exactly what I'm trying to say, that yes, for market value weights, if I'm giving you a market value of a company's equity, we need to understand that yes, it is definitely including the retained earnings. So if it was a book value, I could have taken my job very easily. Balance sheet may we have equity, we have retained earnings, take those values, multiply by the weights. But if they are telling you market value first have to be proportioned between share capital and retained earnings. So there are a couple of questions. Hiral says KE and KR from the last example. Which example, Hiral, you are talking about? We already discussed, I think, are you talking about the few slides back, the first example which we discussed? We talked about the new equity, KR. So the KE had to be calculated as a cost of new equity, but for KR, it was for existing equity. That was a key point, Hiral, if that was your question. I can see your question coming in now though. Karthi says, I think that the taking market value will be appropriate as cost is ascertained based on the current market prices for many securities. Karthik, practical situation, you're absolutely correct. As I said that although we know the practical realities for examination, we have to follow our answer. We have to follow our judgment based on what information is given to us and what is the requirement. So I would not say that you will be posed with a situation where that you have to take your own call and write an assumption. If at all there is something, then definitely I would go ahead with you and you need to mention your assumption that you are taking these weights. But more or less, it will be guided to you in the question itself. I hope that is okay to everyone. Smita, I'm just about to explain that. So, question of Smita is, can you explain the market value for retained earnings? So let us understand this. Guys, everyone, please be careful. When we are using market value as a weight, do you all agree with me that you will have market value of one equity as in total? Do you agree with me? You will not have a separate market value ki share capital market value is this much, retained earnings market value is this much. No. You will get market value of the entire equity together. Do you agree with me? Aditi, yes. Question will tell you the book value and the market value. Hiral, if you're asking me that question again, I have to go back to that illustration. I'm again repeating the illustration we started our class today. Hiral, please appreciate that I specifically mentioned in that example, cost of equity was calculated because it was the new equity being raised. Cost of retained earnings was calculated as cost of existing equity. That was the only difference, 10.4 or 10, whatever the answer was. Please understand, cost of equity was for new equity here, because you read the question properly then. Okay, so great. Smitha, Prabhas, Banreddy, everyone is agreeing with me. So guys, all of you are okay that when we are talking about, so here I request you to focus on this, otherwise you will miss on this point. So when we are given the market value of the equity will include the retained earnings. So let's look at this example. Cost of equity of a company is 10.41, while the cost of retained earnings is 10%. Seems to be the same numbers which we calculated. There are 50,000 equity shares of 10 rupees each, retained earnings of 15 lakhs. Market price per equity share is 50 rupees. Wow. Guys, if the market price of the per equity share is 50, what will be the total market price? Can anyone tell me? Total market value will be 50,000 into 50. Will it be 25 lakhs, guys? Prabhas, the question will not be silent. If at all it is silent, they might not be even giving you the market values. So I think the same question what Karthik asked me. Like, Karthik, if the question is silent and they're not even giving you market value weights, you don't have a choice, right? Take the book value. But if we are talking to extremes that, okay, question is silent, they have given market value and book value both, I would still recommend that, okay, calculate the weighted average cost of capital using both, and so that you are safe over there. But this will not happen. This situation will not arise. Don't worry. If I am a student, if I have time at my hand, I will actually quickly calculate both the ways. It will not take time. It will just take additional 1 minute. Okay. So guys, 25 lakhs. Do you guys agree? This is the market value, but this includes equity plus retained earnings. Do you agree? And what is the equity and retained earnings book value given to us? Can anyone tell me? Is it 5 lakhs and 15 lakhs? Am I correct? Book values? Yes or no? So if my book value is 5 lakhs and 15 lakhs, what I will do is I will use this proportion to allocate 25 lakhs. So 25 lakh will be allocated to equity and retained earnings. So for equity, it will be 5 by 20 into 25 lakhs. For retained earnings, it will be 15 by 20 into 25 lakhs. And hence I will arrive at equity shares. Market value weights are 625 and retained earnings 18,75,000. And we multiply that by WACC. Although a smart student would agree with me that if we are doing this, eventually the weights between the equity and retained earnings will actually be the book value only, because what we are doing, because even if we come out to be 6,25,000 and 18,75, it is like 25 and 75 ratio only, right? 5:15 or 1:3, right? At the end of the day, we are talking about 1:3. Even for cost of capital, even if we are using the market value weights, we are actually using the same weight to calculate the weighted average cost of capital. But it will make difference when there are other components. It will make difference when there are debentures, when there are the preference stock. So you need to know this weight, right? If they are talking about the market value, it is always safer to allocate the market value between equity and retained earnings using the book values. Aditi says, yes, Aditi, of course, if they are not giving you retained earnings, don't worry about it. Na? Take one component as cost of equity, that's it. And Aditi, I think you only asked about the retained earnings. I hope the calculation is clear. And everyone else, how do we allocate the market value of the equity to portions of equity and retained earnings? We use the book value to allocate the market value portions. Gihani says, can you please explain this illustration again? Gihani, do you agree that the total market value of the equity is 25 lakhs? There are 50,000 shares and market value is 50 per share. 25 lakh is the total value of the equity, Gihani. But do we know out of the 25 lakhs, how much is the market value of the share capital and how much is the market value of the retained earnings? We need to split that 25 lakhs into two. And the only way we can split is taking their book value as a weight. Book value is given to us in the question itself. Look at the second line. 5 lakhs equity shares and retained earnings 15 lakhs. So we have 1:3 ratio. Karthik says, what is the logic that market prices aggregate of it? I think, okay. Karthik, because from a market perspective, when you're talking about valuation of per share, do you understand? If you talk about, if you have to calculate the book value of the equity, right? Book value or of the equity, we generally include share capital, security premium, retained earnings, everything, right? So for market value, equity means equity. They are not concerned about the segregate components. So Karthik, I hope that is okay. So for market, it is one equity. Hero, thanks for confirmation. Okay, so guys, so this is something which you need to be just careful. It is not I would say more of a practical challenge here or technicality involved. It is more to be a little bit careful and be safe, guys. So let us try an illustration here with everyone on the screen. I want everyone to be active now. So calculate WACC using book values and market value as weight. So capital structure of a company is consisting of 5 lakhs debentures with market price of 105, 5 lakhs preference shares with market price of 110 and the face value of 100. Equity shares also 10 lakhs. Okay, this is rupees 10 lakh. Mind you, we're talking about rupees value already, right? So don't double convert into or multiply anyways. Market price is 24. Additional information is given to us for debentures, for preference share capital, for equity shares. And they're telling us that firm has a practice of paying all the earnings in the form of dividend, guys. Look at the bottom line. Corporate tax rate is also given to us, and they're saying that use YTM method to calculate the cost of debentures and preference shares. Mind you, even if they would have not mentioned, I would recommend that prefer YTM method. I told you that, right? Instead of the method we used earlier for the irredeemable one, or where we talk about the conversion based on the redemption value and the net proceeds, it's better we are talking about the YTM method. Now, specifically, they have mentioned this. Can anyone quickly calculate that for me for the debentures here? See, we need to calculate so all of you agree with me that calculation of cost of debt, cost of preference stock, and cost of equity is not a challenge here. We need to just do one exercise to calculate each of these components based on whatever learnings we have done till last class. Here, my request is to park your query now, be with the class. Otherwise, what will happen is you will ask the questions which we discussed 20 minutes back. My suggestion to you is probably putting this question towards the end. I will explain you that time, but right now you be with us, whatever we are discussing. So guys, right now it is a YTM method. Guys, anyone remember how do we calculate the YTM method, cost of debt or preference stock? We talked about of two rates. Am I correct? Positive NPV and negative NPV. I hope you guys remember that. So you can pick up a rate depending on whether if it is a positive NPV, take a higher rate to arrive at a negative NPV or vice versa. Yes, Prabhas, IRR. That's what we are talking about. IRR, that is it. Okay, so let's talk about this. You know how we can go about this one. I'm sure a lot of you are having your calculation caps on, already doing some calculations. So let me help you around with this one. So when it comes to cost of equity, it's a straightforward information given to us, right? Can anyone tell me what is the cost of equity here? Something which you can calculate quickly, please. Cost of equity. Probably we have a Gordon model with us, D1 upon P0 plus G. D1, the next year expected dividend is rupee 1. So we're talking about 1. For P0, they're talking about the flotation cost and market price of 24. So 24 minus 4 and growth rate of that is 5%, right? So I believe you might get 10% as the cost of equity. Simple things first, cost of equity 10%, everyone with me? Everyone okay, guys? So let's see how we can calculate cost of debt using a YTM method. So what I've done here is I've taken a discounting factor of 5%. So I'm focusing on this column first. You all agree that initially, if I'm talking about for debentures, 4% is my flotation cost. And do we have a market price somewhere? 105. So what will be the net proceeds, guys? What will be the net proceeds? What will be the net proceeds for us? 105 minus 4%. Do you all agree? Initially, 105 minus 4%. Sarthak, because at that price, they are talking about the issuance. Because if I'm raising the capital in terms of debentures, I will be getting the flotation cost based on the issue price, not the face value. So 105 minus 4%, 100.8. Then we are talking about the interest. So guys, interest is 10% every year, but there is a tax rate also. So interest into 1 minus T. So 10 into 1 minus 30% will give me a 7 interest. So 7 is the interest the company will be paying for 10 years. And at the end of the 10th year, the debenture will be paid off at 100. So when we calculate the discounting, do the discounting of all these numbers using the present value factors, I'm getting a positive 14.64. And I told you guys, Prabhas says, what about coupon rate? We have taken the coupon rate, right, Prabhas? Coupon rate is the stated rate, the 10, that is 10% into 110, but there is a tax implication also. So 10 into 1 minus 0.3, it is minus 7 or the interest payment by the company of 7. Does this make sense? Guys, everyone with me? When I'm calculating the present value using 5% rate, I'm getting a 14.64. So should I take the next rate as a higher or a lower? If I'm getting a positive NPV, the next rate has to be a higher one, higher than 5%. We move on. Okay, Smita says you are not getting it. Smita, what is the doubt? Smita, what exactly is the doubt for you? Can you please tell me? Smita, YTM method we discussed in the last class. Na? If you remember the formula, the IRR method, the lower rate and based on the NPV we calculate an IRR. IRR is that rate at which the current proceeds are equal to the present value of the future cash flows. So Smita, we need to randomly select two rates and calculate one positive NPV and one negative NPV. Smita says, how did you get? What exactly I did get? I took an example of discounting by 5%, right? That's it. So if you're talking about how did I get 7.72, this is present value annuity factor. 1 upon 1.05 plus 1 upon 1.05 square plus 1 upon 1.05 cube and so on. You will go to 1 upon 1.05 10. However, you can get this number from present value annuity tables. So that gives you 7.7217. Karthik, was it a coincidence? I just answered your query just now. Probably. Smita, cash flow minus 7 is okay. What is the interest? Company is paying interest of 10% into 100, 10. But there is a tax saving also of 30%. So interest is 7. Net interest cost is 7 for the company. Hiral, I am not understanding your query. You are saying why in the KE growth rate is not added in the dividend in the numerator. Hiral, please appreciate the call of the question. In the question, they have given you D1. Next year expected dividend. Why would I add the growth rate to the dividend then? D1 is given to you. Guys, I hope everyone with me. I need a confirmation from others also. Everyone with me? We are done with 5% discounting and having a, guys, if you are having a rounding of answer differentiating in points, that's okay. Don't worry about this. Someone is maybe getting 14.4, someone maybe getting 14.7. That's okay. We're getting like a present value of positive 14 point something. Let's say that. Now I've taken a higher discounting rate because I hope you all agree with me that a higher discounting rate will give me a lower NPV. You guys agreed with me in the last class. So I took 7%. I took 7%. And with that, my NPV is minus 0.8. And that's what I wanted. That's why I wanted. So I've given a calculation for 5% and 7%. I hope all okay, guys. I'm sure you guys are with me on this. In fact, let me do one thing. In the meantime, some of you might be doing some kind of a calculations just to be on a safer side. Let me share with you something interesting. So in our presentation, guys, you can see the present value factor. Karthik, you were asking me about this 7.72 and all. If I just quickly show you how does a annuity table look like, I can show you. So we are talking about 5% pay, we are getting 7.72 and 7% pay, we are getting 7.02. So let's see if we have something similar in an annuity table. Let me show you. So I will be highlighting the factors in green, guys. So look at this. This is accumulative present value factors. 5% I've highlighted on the top, 7% I've highlighted on the top. And we are looking for the 10 years. That's on the column period. So you can look at this 7.72 and 7.02, guys. Something which I'm highlighting in green for everyone. Does everyone now make sense? Aditi says screen is not visible. How is that possible? Guys, can you please confirm if screen is not visible? Okay, Rahul, I think you missed a lot of stuff. Probably you could look at the lecture later on. We cannot go back to the first illustration. So, but anyways, guys, everyone okay with the present value computations? You could do a computation using a calculator, or probably the present value factors would be provided to you. So don't even worry about that. I'm just kind of showing you how these factors are taken care, because some of you are having doubts that how these factors are coming in. Okay, so a couple of questions. Okay, great, Karthik. So that's absolutely fine. Karthik, but I hope now you are with us, right? That's absolutely fine. It's good to clarify smallest of doubt. That's absolutely fine with me. Sudhanshu, in the calculator, you can do 1 divided by 1.05 and use the m plus function. Press equal to m plus, and then use the grand total. Try it later or not now, please. Yes, Aditi, thanks a lot. Aditi says that this table is anyways given to you at the end of the module. Yes, Prabhas. Okay, great, guys. I'm actually now impressed that all of you are with me. Now, Raghavan, yes, you will be provided with the rates in the exam or relevant abstract of the table. Either ways, you should know how to refer that, right? Okay, so guys, can we put this in this formula? IRR is equal to lower rate plus NPV upon lower rate upon NPV upon lower minus NPV at higher rate. Guys, didn't I tell you in the last class, if you look at the denominator, NPV at the lower rate minus NPV at the higher rate, and we know that NPV at a lower rate will be a positive number. Am I correct, guys? And NPV at a higher rate will be a negative number. So minus will be a positive. They will clash with each other and it will be a positive. In this case, we are looking at 5 plus 14.64 upon 14.64 minus 0.8 multiplied by 7 minus 5. How do we calculate this? I'm just expanding that understanding. So we're talking about 6.9. So I am expecting that you guys can do this practice later on as well. Everyone should focus on the conceptual clarity at this point of time. Hiral says that why did we use this method? Hiral, did you see the call of the question last line? Use YTM method to calculate cost of debentures and preference shares. It will be given to you. Yeah. So guys, let's move to cost of preference stock. For the preference shares also, you have to do the same calculation. And how much is the preference stock market price, guys? 110. And flotation cost is 2%. Coupon rate is 5% here. But do we get a tax deduction for preference dividend, guys? Yes or no? Do we get a preference dividend tax deduction? I don't think so, right? We don't get it. We don't get it. So let's do that. Now, for the preference stock, our initial proceeds are 110 minus 2%. That is 107.8. For the preference dividends, company will be paying. There is no tax benefit. And I used 5% again, the same factors you will see. And I got a negative NPV this time, guys. If I got a negative NPV with 5%, should I take a higher rate or a lower rate? If I am getting a negative NPV, next rate has to be lower because I have to arrive a positive NPV now. I don't have a choice. Raghavan, thanks for confirmation. Raghavan says that the calculator trick also worked. Great. Awesome. So now it took a calculation for 3% then. 3%, and we got a positive NPV. Guys, I humbly request everyone, probably in the lecture, you guys can devote some time, but if you want to wet your calculations later on, you can do a lot of practice, right? So we'll rather look at more and more examples. At 3%, I'm getting 9.26 as a positive NPV. You can trust on the calculations on the screen right now. If you're marginally here and there, I'm absolutely fine, no issues. So the same formula for IRR and you get 4.09. If some of you are getting 4.07, 4.12, that's okay. I'm again repeating. Because of rounding off, because of the calculation, there is a slight difference in the answer. That's absolutely fine, guys. No one is going to penalize for this. Okay, so Prabhas says there's an inverse relationship between discounting rate. Absolutely correct, Prabhas. Prabhas, wonderful. So there is a direct relationship between rate of interest and the net present value. Of course, so if you're talking about a higher rate, so you will want to have a lower NPV, and a lower rate, a higher NPV, right? Absolutely correct. Okay, so guys, now once we have calculated these cost of capital, that is 6.9 as cost of debt, 4.09 is cost of preference shares, and 10 as cost of equity. What we are left is calculating the WECC using the book value as a weight first, then market value. Let me go back to the question. What are the book values, guys? 5 lakhs of debentures, 5 lakhs of preference shares, 10 lakh of equity shares. Simple 5, 5, 10. So basically we are talking about 1/4, 1/4 and half. And that's what we are doing here. 1/4 for cost of debt, 1/4 of cost of preference stock, and half for cost of equity, and we arrive at 7.75. Whereas for market values, we are given market price, mind you, but do not consider flotation cost in this case. We are using market value based on the number of debentures, number of equity shares, and number of. So what is the market value given to us? For debentures, what are the market values given to us? So we're talking about 105 into 5,000. So we're talking about like 5,25,000 for preference shares. So we're talking about 5,50,000. And for the equity, we are talking about 24. That means the total is 3475. This is the market price. And we are using the same proportion to calculate using the market weights. So 5.25 upon 34.75, 5.5 upon 34.75, and 24 upon 34.75, each multiplied by respective cost of capitals to get my weighted average cost of 8.57. It's very interestingly, we are talking about computation. You need to know this. There will be a question on calculation of weighted average cost of capital. There could be a question on individual component also. They can ask you to calculate cost of debenture or cost of retained earnings separately. But please appreciate the fact that in our upcoming modules, especially with respect to capital budgeting, to an extent in working capital also, we'll be using these. Cost of capital would be a required number for us to calculate, to do or make certain decisions, especially in capital budgeting as well, right? So make sure that this is very important, that we need to know our concepts should be clear for our cost of capital. Okay, Madhushri says, can you explain why PV value is negative for the first year and positive for the other two? Okay, it's basically what we are doing here is, Madhushri, that generally why we are inverting the signs is that our question is that we are thinking from a perspective of investor, right? They will be paying that much or whatever. Like, see, what happens is when we calculate the IRR, there is an initial cash outflow and later on there is a cash inflow. And that is why to calculate the IRR, we invert the signs. That's it. You will do this also in capital budgeting. So good question, by the way. Madhushri, I hope that makes sense. For calculating the IRR, we inverted the signs. That's it. Okay, guys, great. Now, we also want to understand one very important concept before we do more practice. It's called marginal cost of capital. Please be with me on this. This is very important. right? So when we talk about marginal cost of capital, as the name suggests, guys, okay, give me a second. Karthik says, now we know that 8.57 is respectable. So now what interpretation of the decision it will help? Karthik, we will be studying this in capital budgeting. For example, there will be a lot of capital projects with you. They will be providing you a cost of capital in that question. You will not be required to calculate. So based on the cost of capital, you will be discounting and making some decisions on the projects. Sometimes in capital budgeting, you will have multiple projects evaluation. Let's say they will be giving you IRR and they will be giving you to calculate the return on different projects and evaluate whether to accept or reject the proposal. This will be done in investment decisions. So decision making is not now, but later. Okay, I will be taking those modules anyway, so we'll discuss in detail. So let's talk about this now. Raghavan says, can you please repeat the IRR point? Raghavan, it was with respect to more from Madhushri's point. She was asking me that, okay, initially we are talking about positive numbers and negative numbers, which are with the signs are changing when we are calculating the present value. This is because we want to calculate IRR. In IRR calculations, we are using the outflow first and then inflows. We're just using the inverted signs, nothing else. Okay, guys, let me proceed. Marginal cost of capital, as the name suggests, the term includes marginal, which means cost of raising an additional rupee of capital. That means if I have to raise an additional rupee of capital, what would be a marginal cost? Till now, what is the important point when it comes to additional issue of capital, guys? Do you remember some additional cost we need to incur whenever we have to raise an additional capital? Multiple times I have told you. If I have to raise an additional capital, what is the additional minor glitch I have? What cost we need to incur if we have to raise additional share capital or any other capital? Flotation cost, guys? Flotation cost? Smita, absolutely correct. So when we are saying marginal cost is the cost of raising of an additional rupee of capital, try to understand that a business is going on, they're making some profits, they're distributing something as dividend, and they're reinvesting something in the business. As long as the business additional expansion is funded by retained earnings, there is no additional cost, because retained earnings is an implicit cost of capital. We discussed this today, right? Retained earnings, there is no cost, there is no flotation cost. But as we go to expand, raise additional capital from outside, there will be a flotation cost, and that will raise my cost of capital, yes or no? That will raise my cost of capital, right? If you see this diagram, you can see my weighted average cost of capital was kind of stagnant at some point, but suddenly there was a jump at this point because I had to go for additional financing at some point. At some point, I had to go for an additional financing, guys. So we need to understand, how do we calculate the marginal cost of capital? Trust me, without, okay, let me go back a step. Let me tell you, without raising of funds from outside, marginal cost of capital, can we call it as a normal cost of capital because it doesn't change? Till the point of time we are not going to raise additional finance, my marginal cost of capital is cost of capital. But when we actually raise additional finance from outside, that is the point where my cost will change, cost of capital will change. So to calculate the marginal cost of capital, we need to understand the intention of the management. If we want to expand, let's say a company is currently having a capital structure of 20 lakhs with something from debt, something from equity. Now they want to expand and they want to raise another 10 lakhs. Do they intend to keep the same proportion? Yes or no? We need to understand. The only thing that need to be covered up here is that what is the intended financing proportion? Because when a firm raises the funds in a proportional manner and there is no change happening in the capital structure. That means what it means is probably your reinvestment is coming from retained earnings. In that case, your average cost of capital and marginal cost would be same, but that will be only up to the level till the point where I'm going outside for raising additional capital. Because as I go outside to raise fresh capital, then my marginal cost will increase. Then my marginal cost will not be equal to average cost of capital. So my marginal cost of capital is same as average cost till the point of certain capital infusion. So let us understand this concept. Let me explain you this concept with the help of an example here. So give me just a quick second. Just kind of sharing another screen with you guys. Okay, let me see once you can see this question here. Just give me a second, guys. There is some issue, I think, here. Okay, so guys, can you see the screen right now? Only the PPT, I guess, right? Give me a second. That's fine. That's fine. I can see that you can only see the PPT. So give me a second again. Let me try. So basically what I'm trying to do is, and I think now it will be okay. So guys, I hope you can see the marginal cost of capital here. Can you guys see this illustration on the screen? Can you please confirm? Can you please confirm, guys? Okay. Now I want everyone probably just to quickly take a snapshot, or maybe on your screens keep this particular illustration of your module open. Would you be able to do that? Here you would be getting either the present value factors or the annexure. So don't worry. Okay. So guys, I want everyone to keep this illustration handy, the facts. So let us go through this question together and then we'll be working through the solution as well. So ABC Limited has the following capital structure. Examine which is considered to be optimum as on 31st March 2017. So 14% debentures, 11% preference shares, equity shares 160. Company has a market price of 23.6 given to us here. And we're talking about the company has a the next year dividend per share is given to us as 50% of 2017 EPS. And 2017 EPS is what, guys? 2.36. Okay. Company issued new debentures carrying 16% rate of interest, and current market price of debenture is 96. Preference share 9.2 with an annual dividend of 1.5, 1.1 were also issued, and companies in 50% tax bracket. Before we go to the cost of new debt, there are requirements here: cost of new debt, cost of new preference shares, new equity share, marginal cost of capital when no new shares are issued. We'll go to these questions, but I want to quickly check here. Do you conclude something from the EPS, guys? Can you conclude something from the EPS for the last 10 years? Can you conclude something from the EPS? Some information that we might need for equity share cost calculations? Karthik, I just saw your comment a little later when we were talking about the new funding raising. In the case of new funds, because there will be flotation cost, your average cost will change, and that's why the marginal cost comes into the picture. We'll see that in this question itself. Okay, so Khushi says growth rate, Aditi says growth rate. Everyone is like telling me growth rate. So guys, can you see on a constant there is a growth rate of 10% every year? EPS 1 to 1.1, 1.1 to 1.21. Look at even the last 2 years. 2.15 into 10% is 0.21. That is 2.36. Everyone with me on this? So growth rate can be computed 10%. So the first question is, what is cost of new debt? What is cost of new debt here? What is cost of new debt? So they're talking about 16% rate of interest, 50% is a tax bracket, and current market price is 96. So cost of the new debt. For the new debt, we're talking about the net proceeds. So what we are looking at here is, guys, I want everyone to keep that illustration handy with you. What we are looking at here is my cost of new debt is your 16 multiplied by 1 minus 0.5, that's the tax rate, multiplied by the market price, 8.33%. Everyone with me on this? Everyone with me on this? 8.33% is all okay till now. Other information which is required as second part is cost of new preference shares. So in the cost of new preference shares, again, we have a preference dividend of 1.1, 9.2 is the market price. But the point is, there is no tax benefit available on preference dividend. So we are talking about a 1.1 upon 9.2. That's it. That's what we are doing. 1.1 upon 9.2. So we are talking about 11.96 or rounding off to 12%. So cost of preference is also fine with us. But for cost of equity, we're talking about the Gordon's model upon D1 upon P0 plus G. Everyone agreed with me that there is clearly a growth rate of 10%. And in the equity, what is the D1, guys? What is the D1? What will be the D1? We're talking about the dividend information is given to us somewhere. The following is the trend of EPS for the preceding 10% years, which is expected to continue in the future. Next year dividend per share is 50% of 2017. So D1 is given to us. D1 is given to us. Next year dividend, this is above the table, the information above the table. Next year dividend is 50% of 2017 EPS. So 2017 EPS is 2.36 into 50%, 1.18. Guys, everyone with me on this? I hope you guys got it how we calculated 1.18. That's D1. 23.6 is given to us and 10% is what we calculated. So that means we are talking about cost of equity as 15%. Am I correct, guys? Yes or no? So Dhanshu, if they were expecting you to calculate YTM using irredeemable debentures, they would have given to you. If they're not giving to you, you straightforward do this calculation. Getting it? For YTM, they will be specifically telling you. So guys, I hope everyone is okay. Calculation of 3 cost of capital here. Now, the next part of the question was that we have to calculate the marginal cost of capital when no new shares are issued. Didn't I tell you when there are no new shares issued, you're talking about the same average cost of capital. So you have to just calculate the marginal cost of capital as such. Option number B is pretty straightforward. That's what we are supposed to do. Marginal cost of capital when no shares are issued. We know the proportion with us, 30, 10, and 160. Proportion is given to us for the capital structure base. 30, 10, and 160. So part B is pretty much straightforward, where we are talking about that, yes, marginal cost when no stock is issued or no shares are issued. So we're talking about the same cost allocated to the weights given in the capital structure. So 3, 1, and 16. And we come to 13.85. I hope everyone with me on this till option number B. Everyone with me on this, guys, till option number B. Okay, so what do we do now is we are moving on to a very important aspect, which actually explains you what do you mean by marginal cost of capital. That is point number C. And before we do that, I think I just saw the time. Would you like to have a quick 5 minutes break, guys? You can take a quick 5 minutes break. Everyone can freshen up yourselves. We can continue the same illustration and we'll understand the concept of marginal cost of capital going ahead. So let's come back after 5 minutes break, guys. Let's be back after the break. So everyone back, guys. I hope all are back after the much needed break here. Now, guys, let's continue our discussion. Now, I want to talk about a couple of things here. Before that, there was a question from Hiral. Hiral, we also calculated 11.96 only. Just for simplicity, we had rounded off to 12%. 11.96 only. If you see my solution over here. Okay, so guys, what I'm trying to do here is we need to understand the requirement of question number C of this illustration. And there was also a question from Karthik in the option B. If it is asking only debt is issued, will there be no flotation cost? Karthik, if there are flotation costs, they will be providing to you. Generally, flotation costs, are associated with new equity every time. And debt is generally not issued so frequently. So don't even worry about that. If there are flotation costs, because I know why you're asking this, because for the debenture and also preferred share, we had flotation cost concept, right? I know what you're talking about. Now, look at the question number C here. Determine the amount that can be spent for capital investment before new ordinary shares must be sold. Assuming that the retained earnings for the next year's investment is 50% of 2017. Wow. Guys, we are talking about earning per share of 2.36. How many shares are there? Can anyone tell me? How many shares are there? Give me a second. Looking at the responses, 10,000. Okay. Raghavan says 16,000. No. So we're talking about 10,000, right? 10,000 shares. Now, guys, the requirement is you need to calculate that amount that need to be spent for capital investment before new ordinary shares must be sold. Now, my question to everyone is, when we are talking about till the point new shares are sold, that means we are actually talking about a capital structure till the point the new issues is being made. We are actually talking about this particular point. We are talking about this particular point when there is a new issue being sold. So till this range, whatever I'm doing is for expansion purposes, I'm keeping the same capital proportion. And not only that, I'm ensuring that no new equity. So Karthik, like when you said about the flotation cost, in this question, we are only talking about the flotation cost for the equity, right? So when you're talking about the equity, we need to understand, yes, why there could be a different cost. We'll talk about this in a while. But having said that, it's important, it's imperative, we need to understand that, yes, till this point, how can we arrive at, what is the requirement of my question? So if I read that question again, we are talking about that amount that can be spent for capital investment before new ordinary shares, assuming the retained earnings for the next year investment are 50% of 2017. So for 2018, what will be my retained earnings? 2.36 is given to us into 10,000 is the number of shares you are telling me into 50%. This is it coming out to be 11,800? The retained earnings? Is it coming out the same? Can you please double check? $11,800 is what we are looking at this. Now, if you are getting 11,800, what is the proportion my capital structure is having here? 3:1:16. Am I correct, guys? This is what we are looking at, 3:1:16. Now, if that is the case, if this retained earnings is part of the equity, that means my total equity will be 16/20. That is 80%. This is 80%, guys. So that means if I have to carry on the same proportion of capital structure, please try to understand. I'm not changing my capital proportion. 3:1:16, and the equity is coming in from retained earnings. What the question is demanding us, if you again read the question number C, is what is the total amount that can be spent for capital investment before the new ordinary shares are sold? That means we have some amount coming in from equity, 11,800, but that represents only 80%. So that means the amount of investment before new shares will be 11,800 divided by 80%. What is that amount coming out to be? 14,750, guys. 14,750. Am I correct? Can please double check? I will explain this once again. This is a very, very important concept. Let me do this. On the next slide, I'm just kind of putting in that question. The requirement was, you tell us that amount that could be spent for capital investment before new ordinary shares must be sold. And what we are looking at is that the company is looking at the same capital proportion, right? So what is the capital proportion? 3:1:16. Is it everyone okay with me? So the capital proportion is 3:1:16. To maintain this, additional funds, let us say, first we are targeting equity. 11,800 comes from there. And we just calculated that total will be 14,750. That means probably rest of the 3 and 1 are coming from the equity or debt, or preference shares or debt. So you have a 3 as a debenture and preference shares. So we're talking about 3/20 into 14,750. So we're looking at probably 2,213 coming in from this side, or 14,750 divided by 20, 737 coming in from the preference stock. So what I'm trying to say is that 14,750 would be coming from 3 different sources. My requirement was not to calculate additional debentures and additional preference shares. And I think, Karthik, this is what for your point. My requirement was to calculate how much investment can be done without raising new equity shares. And that is 14,750. Nothing else. Madhurshri says, how did I get 80%? Madhurshri, my capital structure is given to us. This. So my equity shares, my equity is 80% of the total capital, yes or no? So my equity is 16/20, 80%. That's how I got it. Guys, I hope this is okay now. Everyone with me? Interesting, isn't it? This is interesting. So now you understood that since we get our retained earnings, until now beyond this 14,750, if I have to invest, I have to bring in, I have to expand beyond 14,750. That means I will have to go for new equity issue. because then I don't have retained earnings anymore. I do not have more retained earnings. Everyone with me on this? Aditi, Karthik, Khushi, Hitesh, everyone. And that is what is my requirement of question number C. The amount that can be spent for additional investment before the new ordinary shares must be sold. A point which is a little tricky, but yes, yet interesting. But once you understand this, we also have a question number D on the top of the next page. Compute the marginal cost of capital when the funds exceeds the amount calculated in C, assuming new equity is issued at 20 per share. Now what? That means they're saying that, okay, you need more funds to expand, more than 14,750. What will be the marginal cost of capital? What do we do then? Will my question here is, need to understand, will my cost of debentures change? No. Will my cost of preference shares change? No. But my cost of equity will change. Am I correct, guys? Am I correct? My cost of equity will change, and hence my cost of capital will change because my weighted average cost will change. Yes or no? So let us look at this. I'm going to the PPT back. So we are all sorted with option number C. We calculated 14,750. That was all said and done. But coming back to our point, for additional capital in excess of 14,750, that means just one thing: new shares have to be issued. And for new shares, we have given that the new price for the KE is equal to D1 upon P0 plus G. The P0 is given to us for the new is 20. So Karthik, I hope you can see that probably they have taken into account the flotation cost as a net impact. So now it is not 23.6 what we were talking about earlier, it is 20. So 1.18 upon 20 plus 0.10, my cost of equity has gone up. What was my KE earlier? KE has gone from 15% to 15.9. Why? Flotation cost. Karthik, absolutely correct. When you said that amount which could be raised without, equity was 14,750, that means the other amount is coming in from preference and debt. But we are talking about the marginal cost of capital because of issuing of additional equity. That's absolutely correct. Yes, absolutely correct. So Karthik is saying that for same proportion, retained earnings was from within, but you would have additionally raised some preference shares and debentures. Absolutely correct. This is what I was trying to say. Karthik, absolutely correct. But the call of the question was something else, right? Call of the question is now in question number D, that what if you go beyond 14,750? What will be the cost of capital? One can argue that, sir, can there be a flotation cost for debenture and preference stock? Yes, there can be, but they have not given us anything here. So we are keeping our cost of debt as 8.33, cost of preference also same, but what got changed is cost of equity. Hence, my weighted average cost of capital, which was coming out to be a 13.85, is now going to be a 14.57. This is majorly being shown as because my cost of equity has changed at that particular point, guys. This is the point we're talking. Don't look at the numbers in the graph, but look at the point what I was talking about. That was the shift, marginal shift, and additional equity had to be raised. Hiral, when there is a flotation cost, yes. But generally we call it, the flotation costs are more or less associated with equity more, right? Great. So I hope you guys are okay with this example then. Everyone is okay, guys? I'm sure part number C and D are definitely interesting. And before going to the details, what I would like to do is, there are more questions to practice. But first, I would like to go to some MCQs. Let's see what you guys want to answer these one. Question number one, guys. Question number two. I want you guys to mention your question number while you're answering. Please mention question number one first. That's fine, Karthik. Absolutely fine. Okay, so question number one, guys. What do you think? Everyone is like very easy question. Like everyone is like tax benefit, we get it only debenture interest. So answer has to be C. Absolutely correct, guys. Super. Okay. Anyone would like to quickly give me a cost of capital for this one? Weighted average cost of capital from your side? This is a quick one. You can just use the weights and calculate quickly and tell me. Weighted average cost of capital for question number two. Treated this as an objective question, has to be solved in 1 minute. Okay, so guys, in this particular question, while I can see answers are flowing in for question number two, it should not be taking so long. We are given preference, cost of preference stock anyways. KP is given to you, 12%. Even cost of equity is given to you, 16%. But cost of debt is something you need to be careful because they've given 15%, but there is a tax also. So probably 10.5. So after that, you have to just apply the weights, nothing else. Once you have, you just apply the weights. So Prabhas says 15.05. Prabhas just need check the calculation. I'm not sure how it can be 15.05. How it can be more than the highest cost. You have the weights very much easy, guys. 50% is your equity, 30% or rather 15% is your preference shares, 35% is your debentures. So everyone else is giving me 13.48. And this is what it is. So we're looking at a cost of equity given 16, cost of preference given. Only thing we need to do is cost of debt as 10.5. And then we had to apply those weights. 50%, 15%, and 35% is 13.48. I hope everyone with me on this. A couple of students who are not giving me the correct answer, but I hope you guys got it where you went it wrong. Great. Let's try more MCQs, guys. Question number 3 and 4. Please mention the question number with your answer. So for question number 3, I can see different answers flowing in already. I can see A, B, and C. So let's talk about this question number 3 first. Which of the following is an implicit cost of increasing proportion of debt of a company? Guys, tell me, based on the information given to us, is there an information for the earnings of the company? Is there any information about the earnings of the company? Even if like there is an increased portion, probably there will be higher interest, right? How can we, and not even, we don't even get have an information of the price of the share. How can we comment that P ratio of the company would increase? How can we comment on that? And even if it increases, can that be an implicit cost? I don't think so. It's not, P ratio is not an implicit cost, right? Tax shield and interest would be less. How would this impact be tax, guys? I don't think option number A and B could be a good answer. What about return on assets? A return on assets may decrease. Now, again, the point is we don't have enough information to conclude. I may say that, okay, there is a additional interest, but again, will that be an implicit cost? Implicit is implied, right? It's not in terms of explicit. But look at option number C. Equity shareholders would demand more return. Guys, what do you think? With more debt, you will be studying financial leverage. With more debt, don't you think the equity shareholders would be having more risk attached to the organization? Would their expectations increase? I definitely think so. I would honestly feel that option number C should be the right answer. It's an interesting question though. Because if you are keeping more debt, more risk to the company, that means the expectations of the equity shareholders will be more, guys. Because more debt, more risk attached to the organization. Okay, Madhushri says, can you please explain point number B? Tax shield in the interest would be less. Madhushri, tax shield, so tax shield cannot decrease, right? If there is an increasing proportion of the debt and the tax rate doesn't change, the absolute amount of tax will actually increase, not tax benefit. Tax shield is tax benefit. If my interest is actually increasing, my tax shield will be more. And we are anyways talking about implicit cost. We're not talking about the explicit. So that is also a key factor you need to worry about. Okay, for question number 4, I can see a lot of students are answering option number B, which looks to be good. Because I think what you guys have done is preference dividend, 18 upon, they're talking about the flotation cost. So I'm sure everyone has done 18 upon 122 minus 4. This is what you have done. So it is definitely B, guys. Aditi says question number 3 is not clear. Aditi, in question number 3, we were talking about implicit cost of increasing proportion of debt. There are two things happening here. One is companies in changing the capital structure, Aditi. Capital structure is changing, that proportion of debt is now higher. And the requirement is, what is the implicit cost? Implicit lies like more of an implied. It's not explicit. Now, as you increase more debt, like the equity shareholders will think that, okay, the company, like there is more risk attached, right? They have more burden on them. Of course, they will have their more expectations risen, right? High risk, high returns. And that's where I'm coming from in option number C. For other options, either they are not correct or they are not implicit. Okay, guys. Great. So now let's do one thing. Let's look at this question quickly then. So now last 40 minutes, we are down to some practice, guys. I hope everyone ready here. Roll up your sleeves. I want everyone to be super active, concentrate hard. We will be doing some practice questions as much as we can, and I will give you homework as well, right? Okay, so let's see this question. A company wants to raise additional finance of 5 crore in the next year. The company expects to retain 1 crore earning next year. The further details are as follows. Amount will be raised by equity and debt in the ratio of 3:1. Wow. Additional issue of equity shares will result in price per share being fixed at 25. debt capital raised by the term loan will cost 10% for the first 75 lakhs and 12% for the next 50 lakhs. Net expected dividend on equity share is also given. Dividend is expected to grow is also given, 5% growth rate, and income tax rate is 12%. So there are 4 additional requirements here. Question number A is determine the amount of equity and debt for raising additional finance. Who will tell me this? Something very easy. Equity and debt. Who will tell me part A, guys? Aditi says 3 and 1. Okay. Aditi, but if you say 3 and 1, don't you think the total equity will be 4 then? And will your ratio be 3:1? You tried your best, but I think I got you. Aditi, don't change the ratio 3:1. Madhushri says 3 and 2. How can that happen? Prabhas says 3. Prabhas, I think your answer is same as Aditi, 3 crore and 1 crore. Those of you are telling me 3 crore and 1 crore, what you are doing is, you are saying that 5 crore mein se 1 crore retain earning, 4 crore is 3:1. But guys, that 1 will be part of the equity, right? So if you're telling me 3 crore and 1 crore, you're actually telling me 4 and 1. So ratio will not be 3:1. So let's do one thing. 3:1 is applied to 5 CR, which gives me equity of 3.75 and debt of 1.25. And since you have already got retained earnings of 1, we are looking at 2.75 here of equity and 1.25 of debt. Am I correct? Aditi, I hope you now got it. So equity will be comprised of 2 factors, 2.75 fresh equity and 1 crore of retained earnings. What I did was 5 crore ko we have multiplied or allocated based on 3:1. So we get equity 3.75 and debt 1.25. And mind you, equity is very much wonderful, right? 2.75 new equity, 1 crore retained earnings. But look at the debt. Debt where we are talking about 1.25. So that means 1.25 is further split into 2 aspects, 75 lakhs and 50 lakhs. Because first 75 lakhs, the cost of debt is 10%, and for next 50 lakhs, it's 50 lakhs. It's 12%. So guys, everyone okay with that? The first part? Yeah, I can see now everyone responding the same language. That's great, guys. Now, give me a second. Yeah. So guys, let's move to the second part. So first part is clear to you. Everyone is clear to the first part. We're talking about 3.75 crores and 1.25. Retained earnings 1 crore, so balance of 2.75, and the 1.25 crore of 75 and 50 lakh with respect to 10% and 12%. Now the next question is determine the post-tax average cost of additional debt. The word is additional debt. Now we have 2 types of debts, right? Can we say that we are talking about a kind of a weighted average within the debt? Can we say that? Am I correct? And we have a tax rate also 25%. So we have a debt of 1.25 crores. We have 75, we have 50. 75, it is 10%, 1 minus T. And 50 is also like 12%, 1 minus T. And tax is 25%, isn't it? Tax is 25%. So that means my cost of debt here is 7.5 and here it is 9%. And the ratio we have is 75 is to 50, guys, 3 is to 2. So we can multiply this by 3 by 5 and we can multiply this by 2 by 5 and that will be our answer. So everyone is giving me a different answer right now. I think we're getting 8.1. Everyone with me on this? 8.1%. 75 lakhs. The ratio we are talking about 7.5 and 9%, guys. Please double check your answers. It should be 8.1. Many students are giving me 14%. How did you arrive at 14%, by the way? Karthik, I hope it is clear now. 8.1% should it be? It should be 8.1. See, guys, don't forget the tax part, right? So we're talking about 7.5 and we are talking about 9%. And since the weightage is 3 to 2, that is 60% and 40%. It's 4.5, it's 3.6, total is 8.1. There could be different ways of looking at it. Aditi says 75 lakhs into 10%. No. Aditi, 10% into 1 minus 20, 1 minus tax rate. That's not 7.5. Aditi, we are not even looking at 75 right now. We look at the 75 for the weightage. We have given in point number 3 the cost of debt, right? 10% and 12%, but those are pre-tax. We are calculating after tax. Guys, don't forget my cost of debt is I into 1 minus T, please. Aditi, I hope you don't forget that. 1 minus T. That 7.5 was arrived as 10 into 1 minus 0.25. Na? 25% is my tax rate. Okay, so everyone with me till 8.1%. Then we have third question, guys, to determine the cost of retained earnings and cost of equity. Now, they're asking you cost of retained earnings and cost of equity. And we're also looking at additional equity. So now in this case, obviously, what we need to understand is, we know that, okay, cost of retained earnings is equal to cost of equity, that's fine. But the information we are having is only with respect to the Gordon dividend model. Now, we are talking about next expected, I think it should be next expected dividend is 2 per share and dividend is expected to grow at 5%. Do we multiply this by 1 plus G or we don't need to multiply by 1 plus G, guys? The dividend is given to us 2 per share and expected to grow. And we are talking about the next year. We're talking about the next year. Okay, Khushi says, why multiply by 3 by 5 and 2 by 5? Khushi, what is the debt ratio? 1.25 crores comprises of 2 types of debts, 75 lakhs and 50 lakhs. What does that ratio comprise of? 3 to 2. Khushi, that is a ratio. So we are talking about cost of equity. We are given 2, the dividend for the current year or the net expected dividend, but we are talking about the next year. So we are multiplying this by 1.05. So 2 into 1.05 upon P0, that is 25 plus growth rate. So we're getting 13.4% as. So I'm getting a lot of responses at 13.4 by Prabhas, Hiral, absolutely correct. So Yes, Hero, that will be, it is 13.4. Absolutely correct. Smitha and Karthik, we will be multiplying it because we are talking about the next year. We will be multiplying it because we're talking about the next year, right? So now once we have these cost of equity, cost of debt, cost of debt in terms of the weighted average, because there were two types of debt, we have to just multiply that by the weights to calculate our WACC. That is what my final part, the WACC of additional finance after tax. So we have 13.4, we have 8.1, and we just need to multiply that with the ratio of 3.75 crores and 1.25 crores, and we get 12.075%, guys. So the answer is absolutely correct. Yes, Karthik. So I think that confusion was about the net versus next. So probably they are talking about net only. And yes, for the current year. Guys, everyone okay? Any doubts in the calculation of the weighted average cost of capital, please? Any doubts on the weighted average cost of capital, please let me know. Else we are proceeding for another interesting question here. Great. Hitesh, these are already uploaded. Hitesh was asking me with whether this PPT, this slide is all uploaded. It's already uploaded, guys. Can you please confirm? I had already uploaded this couple of days back. Okay, so let's move on to the next question then. Question on the screen with Mogambo Limited. Seems to be a villain of some Indian Bollywood movie, right? Mogambo Limited. So I think Mogambo was some kind of a villain in some kind of a movie. I'm sure you guys might know that. I think it will be equally appreciated that you know the chapters you studied 1 month back. Interesting. Okay, so Mogambo Limited wishes to raise additional finance of 10 lakhs for meeting its investment plans. It has rupees 2,10,000 in the form of okay, I have just query. Smitha, there will be a couple of questions in the PPT itself, which I will be giving you as an assignment or homework. Okay, don't worry. There are a couple of questions which I will be giving you as an homework within the PPT, which you could look at later on as an assignment. So, so Mogambo Limited wishes to raise additional finance of 10 lakhs for meeting its investment plans. It has rupees 2,10,000 in the form of retained earnings available for its investment purposes. Further details are given as follows. Debt equity mix is given to us 30:70. Cost of debt before tax is up to 1,80,000 10%, and beyond 1,80,000 it's 16%. And EPS is 4. Dividend payout is 50%. Expected growth in dividend is 10%. Market price is talking about 44, and tax rate is 50%. So couple of things. Karthik says, sir, have you taught? So you're talking about effective interest rate, Karthik. So that is something I mentioned briefly when we were talking about the last class about this, why the debentures are issued at premium and discount. That was the only discussion we had in the last class. Okay. Now, what are the requirements of this question, guys? Question number A. What should be the pattern for additional finance here? Who will tell me this? Aditi already has an answer. Aditi says that, okay, this time I will not fool around. Aditi is very spot on in her answer. She says that, okay, I know what I did in the last question. Okay, so what about others, guys? What should be the pattern here? For the additional finance? We have just one answer as of now. So they have mentioned some ratio to us, right? Sudhanshu looks good. Madhushri, I'm not so sure, to be very honest. I think some of you are doing the same error. Madhushri, what do you think? The retained earnings will be part of equity, right? If you want to add that, if you're calculating 553, if you add the retained earnings of 210 to 553, will your mix be 30s to 70? I doubt. How much you want to raise additional finance? 10 lakhs. So your equity and debt. Debt is 3, equity is 7. So I think equity will be 7 lakhs. Debt will be 3 lakhs. Now, just like we did in the last question, there is already a retained earnings of 2,10,000. So the new equity will be required to be a 490. Am I correct, guys? And then out of 3 lakhs also, can we say 1,80,000 at the rate of 10%? And remaining 1,20,000 at the rate of 16%, guys? Am I correct or am I correct? This is what we're looking at. So let's move to question number B then. To determine the post-tax average cost of additional debt, cost of equity, and cost of retained earnings. So let's first calculate additional debt, guys. You know what to do, right? We have to calculate the cost of debt of each debt after tax. And then you have to also do the weighted average within the debt, because there are two types of debts. Two types of debts, guys. So I'm just waiting for the answers from your side. So cost of debt, I've got few answers as 6.2%. Okay. So let's see how did you guys do it. So we're talking about after tax will be 50% tax, right? 5% and 8%. And the weightage is 60% and 40%, right? So 5 into 60% and 8 into 40%. It seems 6.2 to me. So good. I think many of you have given me the correct answer for cost of debt. We are talking about 6.2%. Looks good, guys. Right? So getting 6.2 here. Now, we move to the cost of equity and retained earnings. So cost of equity being equal to cost of retained earnings unless given otherwise. So let's see what are the information here. So we have D1 upon P0 plus G. And what is the D1, guys? Have they given us dividend here? Probably they have given us the EPS and dividend payout ratio. So we know that my dividend is 2 per share. My dividend is 2 per share, but there is a growth rate as well. So we need to calculate D1 as 2 into 1 plus G, that is 1.10, that is 2.2. And P0 is 44. So 2.2 upon 44 plus the growth rate of 10%. So it seems that my equity cost of capital is 15%, guys. Everyone okay here? 15%, guys. 15%. I hope all are with me. Now we move on to the overall cost of capital, which is very basic stuff. We know the 15%, we multiply it by the 70% and the 6.2 multiplied by 30%. We know the debt equity capital structure mix and we get cost of capital as 12.36. I think everyone is on the same page here. Any doubts on this one, guys? I think pretty similar to the last question we had. I hope everyone is okay. Are you guys feeling comfortable now calculating the individual components and weighted average cost of capital? Mind you, there will be a standalone question on this one, and it's very important that you guys gain that confidence. And I'm sure the way you can gain the confidence is by doing more and more practice. Okay, so let's target last question of the evening. And then I will give you one question for assignment also. Later on, you can attempt after the lecture. Of course, you have more questions from your past year exams. I would strictly recommend to complete all the questions from your study material. I think I have covered few illustrations and few questions. The rest of the questions and some past year exams, please do some practice. So the last question I want to cover today is, okay, before that, there is a question from Karthik. Yes, Karthik, that's what I said in the last question itself, because they have not given any flotation cost. In the absence of any other information, we assume cost of retained earnings and cost of equity same. But your question is valid because since we, or other way around, Karthik, they should have given one existing cost of equity. Then I would have said that, okay, there are two types of cost of equities. Existing would be retained earnings and the new one will be new. So they did not give anything else. So that's why we are assuming the same. Yeah. So guys, let's target this last question here. So ABC Limited has the following book value capital structure: equity share capital, reserves and surplus, preference shares, 8.5 debentures. Mind you, in the bracket, they are talking about the number of instruments also. 1 crore shares, 5 lakh shares of preference, 1.5 lakh debentures, 12% term loans. And they gave a lot of information here. Debentures of ABC are redeemable at par after 5 years and are quoting at 985 per debenture. Current market price per equity share is 60. Prevailing default risk-free rate is given as 10-year Government of India Treasury bond is this. Average market risk premium is 7%. Beta of the company is 1.85. And the preference share is given as redeemable after 5 years and selling at 102. Tax rate is also given. What they're requiring us is the calculation of, look at the requirement. Calculate the weighted average cost of capital using market value rate weights. So let us do one thing. Let us attack this one by one. We together solve it. What do we need for a weighted average cost of capital? Individual components, right? So can we look at debentures first, guys? What would be the cost of debentures? And probably also the term loan, because both are debt. Cost of debentures, guys. So they have not talked about the yield to maturity in this case. They have not talked about the yield to maturity. What will be the cost of debentures here? Can anyone calculate that? So we have 8.5% debentures, right? So 8.5%, if we are talking about the interest, is 85. 1 minus T. Plus, we are talking about redeemable after 5 years. So we are talking about the redemption value minus the market price. So 1000 minus 985 upon 5. And then 1000 plus 985 upon 2. Am I correct, guys? This is how you will be calculating the cost of debentures. So I'm getting some responses from people as 5.87%. The calculations which you guys have done, I guess there are 3 or 4 students have given me answers as 5.87%. You guys can check the calculation, please. As I said, the next piece can be looked at as cost for loans. But loans is very simple. We're talking about 12% into 1 minus tax rate, guys. Cost for loans, we have loan capital as well, like in terms of debt only. So this should be 7.8. Now, moving ahead, we are talking about cost of preference shares. Who will tell me the cost of preference shares, guys? I think the only thing we need to talk about is that there is no tax benefit there, right? 9% preference share is given, like 9 is my dividend. And then we have current price is 102, but they're redeemable at 10% premium. Wow. So 110. And since we are talking about the existing preference shares, guys, 110 minus 102. Upon 5. 110 plus 102 upon 2 here in the average. What is the cost of preference shares, guys? Hitesh says it is 10%. Can you please double check? We are talking about 10% here. So this is 10.6 upon 106. Yeah, it seems to be 10% to me. Seems to be 10%. Now we're left with last faction, last position, that is cost of equity. I want every eyes on this screen right now. For cost of equity, we have information given for cost, the capital asset pricing model here, which says it should be risk-free rate plus beta into RM minus RF. We have given the risk-free rate, that is your treasury bonds of government, 5.5. Beta is given to be 1.85. And then RA minus RF. Should we do 7 minus 5.5, guys? Yes or no? Should we do 7 minus 5.5 or no? This is my question to everyone. In the bracket, should I do 7 minus 5.5 or no? I want to check if everyone is awake at 8:25 p.m. Active. Akash says, you are kidding with us. Akash says that they've already given average market risk premium. And you only told us that risk premium is RM minus RF. It is already given to us. So straight away multiply that by 7. And probably what number you are all are giving me is 18.45, seeming to be absolutely correct, guys. Absolutely wonderful, guys. This is the only point which I wanted to test you guys in the question. Rest everything, I'm sure you guys are doing it smoothly. So that is 18.45. You guys are actually, fantastic in the calculations it seems today. Now, the ultimate requirement of calculating the weighted average cost of capital is using the market value weights. Now, it is very important that we know what are the weights given to us in terms of the market value. So, few things important here. That yes, they're talking about the current market prices 985. Then they're talking about the equity at 60, preference share at 102. But you also need the numbers, right? So equity share is 1 crore, preference share is 5 lakhs, and 8.5% debenture and 1.5 lakh debenture. So you have to just multiply these and calculate my market value here. So these numbers which I have given here is in lakhs. So we're talking about 60 into 1 crore. Similarly, 102 into 5 lakhs. And then we're talking about 985. But for term loan, there will not be any changes. For term loan, there will not be any changes. Is everyone okay here? So what we need to do is we need to calculate the market value of these securities. Term loan continue to be at the 500 lakhs here. So what we're doing is we are just calculating the market values. Based on that, we have used the weights and we multiply the respective cost of capital to arrive at the weighted average cost. I hope everyone is spot on with this particular question as well. Okay, Aditi had a question for term loan. Aditi, what do you think? Term loan is in the nature of equity or debt? So term loan also you have to repay, right? You pay an interest on the term loan. There's a tax benefit. And that's what I said, that term loan we calculate just similar to debt, interest into 1 minus tax. That's it. I hope this is clear. Hiral says personal income tax formula. Hiral says like, Hiral, so you joined late probably. We started our session with personal income tax where we were talking about 1 minus T into 1 minus F. There we were talking about whenever they give you the income tax and the flotation cost for cost of retained earnings, you need to think that, okay, if those retained earnings were distributed as dividend to the investor would have paid tax on that. So investor would have got only net proceeds, net of flotation cost, and even net of the tax. Flotation cost is anyways more from a perspective of the new issue or whatever. But yes, when we're talking about distribution and the company has to charge, or rather the shareholder has to pay the dividends and receive the dividends and pay tax on that, and that's why we do 1 minus T. Hiril, I hope that is okay. So that's why we used 1 minus T over there, because had they received that as a dividend, they would have paid tax on that. Okay, Akashni has a question. In case of growth approach, is a lowercase g equal to the uppercase g? You're talking about the growth rate, right? D1 upon P0 plus G, that's fine. This is absolutely okay. Any other questions, guys? Any other questions from anyone? Okay, so I think time for a good assignment for you guys. So I'm sure, can you just please confirm if you had actually seen the file uploaded by me? This file is already uploaded by me with all the solutions, explanations. So there is one question in that file, which is on your screen now, which I want everyone to do as a homework. This question is for homework for everyone. There is a solution also given to the same, but I want you guys to try on your own. And I can just give you a little bit of a jinx of the question. What is the requirement here? Right? So, see, the idea is we need to understand that they have given you a capital structure. They've given you the cost of debt and cost of equity. But the interesting part is that the cost changes as the project cost increases. You can see that, right? and they're asking you the cost of capital for two different projects. The funding requirement is 6.5 and 14 lakhs. So you need to know that, okay, I'm just going to giving you a little bit of a hint how to go about this question, guys. How to go about this question, you need to know that, right? So let's say, so we're talking about the exact range which is given to us. Up to 2 lakhs, above 2 lakhs to 5, up to 5 lakhs, 5 to 10 lakhs, and 10 to 20 lakhs. So we need to know, right? So what exactly is my cost, weighted average cost of capital in each of the scenarios? So what you need to do is probably in a question like this, that we need to calculate the cost of debt, cost of equity for projects in every range. And then you have to calculate the WACC. Then you have to see that there are two projects. One is requiring 6.5 and one is 14 lakhs. So 6.5 will fall under the third range and 14 lakh will fall under the fourth range. So then they're asking you that, okay, should you, or under what condition will that be an acceptable? If the project is to give a return of 10%. So let me ask you, we are talking about if a project has to be accepted. Now I'm kind of ending this session with a note, because the next time you guys will be meeting me with for investment decisions, and we'll be continuing our discussion from here. For any project to be accepted, that project has to give return more than the cost of capital. Am I correct? So if you calculate WACC, if it is lesser than the project return, you can take the project. But if it is higher than the project return, you cannot take the project. Simple point. We will take this discussion going forward in our investment decisions chapters, guys. So till then, I would like to thank you all for joining in. I'm sure your concepts with respect to cost of capital and everything else is sorted out. I request you to continue your momentum. Please continue the practice. A lot of practice is required. I'm sure some of you know that. So WACC question is for sure, you will be seeing that as one of the questions. So you need to do a lot of practice for remaining questions from your study material and even also in the past exams. So please continue your hard work. And I'm sure we will have a lot of fun in the next sessions, and we will have a couple of sessions on investment decisions. I'm sure that will be very important, capital budgeting. And we will be talking about the net present value, IRRs, and so on. Some practice will be there. And then we'll have a series of sessions on working capital at the end as well. See you guys. Until then, take care. Happy learning. Keep on the good work. Thank you, everyone. Good night, all of you. Cheers.